First off, wanted to thank everybody, for joining us. This is our second one. We're going to do maybe a couple more of these throughout the year. Wanted to thank Kaaren and her team at uDirect IRA Services. We'll have her, speak up here in a minute. But I am Ben Suttles, one of the managing partners here at Disrupt Equity. Again, wanted to thank everybody for joining us today. We're going to go through, a little bit about multifamily, a little bit about why you should invest through a self-directed IRA and why that's one of the most efficient vehicles. We've done a lot with SDIRA investors throughout the years, and Kaaren and her team are just top notch, and really enjoyed getting to know her last year. And we decided to do a couple of these webinars just to kind of educate people. We're not here to sell anything. There's not an investment that's going on. It's purely educational. There will be a little bit of Q&A at the end, so feel free to kind of keep those those questions till the end, and we're happy to kind of carve out some time for that. But Kaaren, let me see if I can turn you on. Can you hear me?
I can hear you. Can you hear me?
I can hear you. All right.
That's wonderful. Great.
Yeah. So you want to go ahead and introduce yourself real quick?
Yeah, I would love to. I would love also for you to be able to see me, but we'll work on that later. But I am the CEO and founder of uDirect IRA Services. I founded it in 2009, and we've helped just thousands and thousands of people to take their retirement funds from Wall Street and invest them into assets that they really understand, like real estate, in all of its different forms, including notes, including private equity, including just so many different ways, so many different levels. And multifamily has always been a big asset class.
No, we love it, right? And I think there's going to be a lot of opportunity to kind of talk about outside of multifamily. I mean, how do you leverage your SDIRA to invest in other assets too? And so I think Kaaren can kind of get through that. But Kaaren, do you see the screen? I just want to make sure that I'm sharing the right one here. Do you see the presentation?
I do. I see the intro screen. It looks just perfect.
Let's see if I can actually control this real quick. So, let's see. All right, there we are. There's our beautiful faces. Me, I am the bald guy on the right, as everybody probably assumes, right? And there's Kaaren right there. So again, thank you everybody for taking some time. A little bit about Disrupt Equity Partners. We founded the firm back in 2017, been in commercial real estate since the GFC. Track record since inception of Disrupt Equity, that is about $1 billion in assets that we've acquired. We've held 8 full cycle dispositions. We've acquired over 27 properties in 3 different states, and some of the awards down there that we're really, really proud of as well, right? So, Kaaren, you want to talk a little bit about uDirect IRA Services as well?
Well, sure. I mean, what the service that we offer, it's funny because when somebody asks me, like, socially, well, what do you do? And I say that I have a self-directed IRA company. I mean, a lot of times they don't understand what that is. And that's funny because you've been able to self-direct for 51 years, which is astonishing. But
Wow.
right. But what we do is give asset sponsors like yourself access to capital. It's something like $45 trillion in American retirement savings altogether that can go out into alternative assets. And we provide all kinds of education and administrative support, including a book that I co-wrote with Bigger Pockets called The Bigger Pockets Guide to Self-Directed IRA Investing. So that's part of what we do here. And there's so many different, we say the self-directed IRA, right? But it's not just an IRA. It's different kinds of IRAs. It's like a traditional, like you say here, a Roth, a SEP, a simple IRA, solo 401k, could even be an HSA, a health savings account. And so that really helps people to be able to self-direct into alternative assets with all these accounts. And like your slide here says that we do offer a flat fee structure. And so we don't, if your account grows, we don't penalize you by charging you based on assets under management. It's just a flat fee. People love that because, we don't want to penalize you for doing well. That's kind of the point, right?
No, and working with Kaaren, I mean, her team is incredible. I think a lot of it is about the customer service too. And I think they take care of their self-directed IRA clients. They try to steer them in the right direction. And like I said, flat fee structure, we've done a lot of business with other IRA firms, and that's not necessarily the norm. So, if you guys have questions, she is the expert at this. And so leave all your really technical questions till the very end, and we can
Oh
kind of
yeah,
get
bring
into
it.
this. Right. So on the multifamily side, right? So if multifamily is the opportunity, a self-directed IRA may be the vehicle, right? So essentially what an IRA is it's or self-directed IRA that is it's an opportunity for you to have more flexibility over your IRA account and invest into things like commercial real estate, right? And so, our background is in multifamily, acquisition, management, and development. And so that's kind of our bread and butter, right? And so we've worked with a lot of IRA investors over our years, and we kind of white glove it. There is some paperwork. We can kind of get into the process a little bit more in here, but why multifamily, right? I think one of the reasons why I'm still a bull, I think there's been a lot of noise in the market around multifamily, and we'll own it, right? There ultimately is, it's been tough with interest rates, insurance, and inflation, right? The three I's is what I always tell people has been the challenge for multifamily investing, and really real estate investing, to be honest with you, for the last 3 or 4 years. I think some of that stuff is starting to get better, right? The last 30 days aside, interest rates have ticked down. Inflation has gotten better. And in the insurance markets, which I'm sure everybody's still grumbling about, your home insurance, your auto insurance, that's just gone up quite a bit over the last few years, right? All of that really affected multifamily. But one of the reasons that I'm still a bull is that you need housing, right? I'm sitting here right now in an office building. I don't need an office building, right? We don't need an office to be able to conduct our business. Some businesses do, but not all of them, right? So it's not essential, right? And so people always need a place to live, right? There's a lot of tax advantages, right? Not only by investing through your self-directed IRA, but if you don't invest through your IRA, there's also tax advantages, right? It's a tangible asset, right? I think a lot of our investors love to know what they're investing in. It's not a piece of paper. It's not a stock. It's not this online thing like crypto, right? And I invest in all of those things too. But this is a real thing that you can go by. You can kick the tires. You can point to your spouse and say, "We're an investor in that project," right? And I think people really, really like that. And at the end of the day, the building and the land that the building is sitting on has value, right? It's not going to go to zero. And so there's always some tangible value in investing in real estate. And that's one of the reasons that I loved it. Another reason that you can get into you want to invest in multifamily is it's got a lot of fixed rate opportunities, right? So what does that mean? It means that the rates that can kind of go like this. Yeah, they're still available, but you can also get fixed rate debt from Fannie and Freddie, right? And right now we were just looking at a term sheet, 5.5% fixed for 10 years, right? So long-term fixed interest rate debt is very much a thing. In fact, multifamily gets the best debt out of all commercial real estate classes because, again, Fannie and Freddie's mandate is to provide affordable housing. So they really back, investment firms and investors that want to invest in these projects because we're providing something to the community, right? We are investing in these properties and making sure we're maintaining them, and we're providing affordable housing to people, right? It's a scalable and an efficient way of investing in real estate. I used to be in single family. I used to flip homes. I used to have rentals. They were all over Houston, right? And it was the most inefficient way of being an investor because I was driving around town most days, right? Whereas I can buy 300 units. It's on this block. I can pour all my heart and soul into it. I can have proper property management and people actually, managing that deal. And it's an efficient way to deploy capital into commercial real estate. And that's one of the reasons why I love it. Cash flow, right? There's a lot of cash flow potential. Right now, it's probably in that, call it 5 to 7% range, but when I got into this, it was, easily 10 plus, right? And so it just depends on where the market is, but there's also a lot of appreciation that you can capture too, right? So, one of the reasons that I love investing is the tax advantages. Again, we're talking about self-directed IRAs. One of the most, incredible ways to invest in anything, right? But then you have cash flow, then you have appreciation, then you have the ability to scale this. And it really makes, one of the reasons why multifamily, or the several of the reasons why I like multifamily, right? So multifamily market trends. Now is the time to invest, right? So people they're feeling the pain. They're wondering, why would I want to get into it right now? I'm going to tell you now. Don't think about what happened the last 2 or 3 years. Yes, it was challenging. It was not fun. We'll all look back and say, hey, what could we have done differently? But that is the time to understand that at the end of the day, real estate's like dollar cost averaging. You always want to be in the market because you can even out and eventually get back in the black if you stay in the game. If you liquidate all your things and you never get back in the game, then guess what? You just locked in a loss. Right. And so I think it's important for people to realize that regardless of what pain you might have gone through now or in the near past, that is, don't think of it as it's always going to be that way. Right. Again, go back to the fundamentals. They're there for these projects, right? You need housing. We're investing in high growth and high population job growth markets, right? Rents are going to eventually go up. And some of the stuff's right here in this, there's a lot of supply and demand strength, right? Over the last 3 years, supply has been, ultimately going through the roof. These investors, they put a lot of projects out after COVID, and a lot of those got delivered over the last few years, and that really hurt the market, right? Because rents went down because there was a lot of supply, right? All of that is falling off a cliff at this point, right? All while the demand for rentals is still there, right? So rents are stabilizing. You got strong demand for these rentals, right? You're investing in operator driven investments, right? Well-capitalized, experienced operators outperforming in today's market, right? I think the one thing that's important is investing with the right people. It's like investing with Kaaren and uDirect, right? You want to put your money with a firm that knows how to be a good fiduciary and knows how to educate you and ultimately steer you in the right direction. And I think the people that have made it through these last few years have learned a lot, and that's going to make them even stronger going into this upcycle, right? And then I think, again, going back to the debt side, right? There's a lot of good interest rates. I mean, a 5.5% fixed rate for 10 years, that's not bad, right? And I think that really de-risks a lot of these projects. Where in the past there was a lot of free money, there's cheap money. It was on bridge loans. And I think that ultimately made it very, very tough for a lot of these operators, right? So what to evaluate in a multifamily or opportunity that is. So let's talk about track record, right? I think the most important thing, I'm an LP on a lot of deals too, not even just on our own project, but in other people's projects. My first question is, how much money are you putting in the deal? Skin in the game is important. Experience, execution, and performance across prior deals, right? Track record. I think that's the first thing that you talk about is get to know your sponsor. And this is not even for multifamily. It's not even talking about us. It's talking about anybody that you're going to put money behind. Do your research, right? And that's even Fortune 500 companies that you might be, trying to invest in stocks, right? Do some basic research. Don't just take the word of an article that you read or somebody made some suggestions. Do your own research on the people that are actually, doing the day-to-day with that investment, right? The debt structure, we talked about this, the loan terms, the leverage, the interest rate risk. Underwriting assumptions, right? How realistic are these revenue and expense and exit projections? I've seen really, really crummy deals look really, really great because the assumptions were very, very aggressive. And so I think you need to stress test and push the sponsor to justify their assumptions, right? Say, hey, I see that your underwriting to your rents are going to go up 10 years, year over year for the next 10 years. Is that achievable? Then I'm going to tell you absolutely not. But, then that's a wild, big example. But the point that I'm trying to make is that those are the questions and those are the things that you need to be looking at. What are the anomalies? What are they doing that might be perceived as being aggressive? And maybe there's a good justification for that, but you need to ask those questions. The market and asset quality. I mean, this is one of the most important things, to talk about, but people, I think, put it in front of sponsors and put it in front of how the deal's structured. Then I think people kind of get caught up in the property and where it's located at. And I think that's important, but I'm actually saying that this is probably the way that you should look at deals. Start with the person that's putting the deal together. You're backing the jockey, not the horse, right? But then you're going to quickly get to market and asset quality, right? So the strength of the location, which is the old adage is real estate's all about location, location, location. Yes, it's a little bit of a cliche, but it's absolutely true, right? And so you just need to understand that, right? And what are the demand drivers in that area that's going to make that property successful, right? Is there job growth, right? Are there jobs coming to that area? Is there a sustainable job base in that area? Are there big companies that are never going to move or, thriving industries that are really driving, sustainable growth in that area? Is it landlord and business friendly? Is it tax friendly, right? And not all of those have to check some perceived box. I think ultimately when investing, you need to understand some of these risks and you need to ask some of these questions, but ultimately you need to invest in the projects that you like and that is going to ultimately align with what your family and what their investment goals are, right? And what your retirement goals are, right? Oh, and I'll give you an example. Certain people that are like, I'm not going to invest outside of California or Texas or Florida, or I only like this type of stuff or that type of stuff. And that's fine. You've defined what your buy box is and stick to it, right? But some people aren't that rigid about it. But I think it's nice to have a thesis and stick to it. And then I think last but not least, transparency and reporting. How clearly does the sponsor communicate? How frequent are the updates and how thorough are the updates? I mean, it takes up probably about a day or two of my month, but we push out monthly updates, full financial package to investors on every single one of our projects. It's not what is the norm in our business. In fact, a lot of our competitors do it quarterly, but right now, that is what needs to be done. And we've always done it that way. And I'm happy to provide that level of transparency to our investors. And I think that's important, right? Because you need to know the good, the bad, and the ugly, right? Are you hitting the business plan or are you not? And if you're not, why not, right? And so I think that transparency is important. So a little bit about our track record here. I'm not going to get into all of this stuff. I don't want to pump my chest too much, but there's just some kind of indicative deals. 7,000 units under management. We've had up to 10 full exit. At the end of the day, it's about 35% average analyzed returns that we've had with our investors. And obviously, full disclaimer, past performance is not indicative of future performance. I got to do the CYA, but we're really proud of some of these projects. So why investors use a self-directed IRA for multifamily? So Kaaren, you want to take this one away?
Yeah, with self-directed IRAs, the account holder is always choosing their own assets, and we don't recommend any particular assets, but our account holders really do love to invest in this asset class. So it takes you just beyond the stock market, and it's nice to be able to diversify, right? Because you never know which, like Ben was just saying, multifamily was, had a wacky couple of, years, a few years ago. And so everything goes up and down. And so you just definitely want to diversify. Ben was also talking about the tax advantages of self-directed IRAs, and they really are huge. So when you make a contribution to an IRA, a lot of times you can deduct that from your taxes. In other words, like we say, pay yourself instead of the IRS. So may as well contribute to your IRA instead of sending it to the IRS. And you can also invest in what's called a Roth, if you're not familiar with it. Roth refers to the name of a senator who passed the ability to put in after-tax dollars and contribute them into a retirement account, but then let the growth go forward and grow tax-free for life, as long as you meet a couple of conditions. So it grows tax-free for life. So huge tax advantages in self-directed IRAs. And you have control as opposed to some asset manager who is making the decision of what assets are going to be part of your mutual fund, for example, or index fund or whatever you have. I mean, you're picking the asset. And we also mentioned diversification already, because it's not just private equity like syndications. You can also have your IRA invest as a debt partner, not just an equity partner. Super powerful. Your IRA can lend money just like a bank. Your IRA can do a lot of other things, invest in crypto, invest in precious metals. So lots of ways to diversify your portfolio. And you do have access to passive income, just like, the big guys. In fact, it's great that we have the ERISA laws and also the SEC laws the way they are now, where it's not just the super wealthy who can invest in these assets. Sometimes you have to be accredited to invest in these assets. That's true. But you have access to passive income, right? So private placements can give you this kind of cash flow in retirement. And if you're not in retirement yet, that cash flow goes back to your IRA, you build it up, and then you have enough, and you grow that idle cash, it could be, and then put it out into another asset. So just all ways to compound and grow your retirement. And with self-directed IRAs, you're doing that in assets that you choose, that, like we say, uDirect, right? And asset classes that you understand. Right, Ben?
Absolutely. Yeah. I mean, I think the one thing that I love about it is it gives you as somebody that's trying to maximize their retirement account the freedom to go beyond the stocks and mutual funds, right? To go beyond what, the Fidelities of the world. And don't get me wrong, I have an account with them too, but they're going to have a basket of things that you're only allowed to invest in, and it's very, it's restrictive. And I think this gives the power of your retirement back into your hands. And that's really why I love self-directed IRAs.
It's so true. People will ask me, hey, in fact, I just got an email like, hey, Kaaren, what should I invest in? Well, I can't tell you, you know, sorry. But,
No, you still got to do it. That's probably one of the big points I'm trying to still do your due diligence.
yeah.
Don't just invest in whatever,
Oh,
but at least
100%.
it
Yeah.
gives you the ability to invest in different things than just, cherry picked, stocks and ETFs that they're probably getting a commission on.
So
And
true.
so, and that's probably one of the biggest things. And again, we all come, well, not all of us, but most of us have come from corporate America, or we've had, different versions of this. And I think the other thing that Kaaren and her team can help is can you roll out of it? Can you get it into a self-direct? Like they really help educate you on that process because it's not always straightforward,
No,
right?
no, you're right. There are rules for sure. And we could
Yeah.
go, deep on that if you want to later on.
So let's get into this. So how does the investment process work, right? So, Kaaren, you want to kind of talk through it as it pertains to, let's just say, for example, it's a multifamily,
Right.
investment. How would it kind of work for an investor?
Yeah, well, and like Ben says, it's a simple process, and you need to do your homework first. So first, you do your homework, okay, and that's phase zero. You do your homework, and you decide what you want to invest in. But then you open an account. It's so simple. We have a digital form on our website. You could just like 10 minutes later, you've got an account. It's not brain damage. The second step is to move money into that account so you actually can invest. And the way you do that is by transferring an IRA, just IRA to IRA transfer. And because when you're doing that, it goes from custodian to custodian, it is not a taxable event. A lot of times people worry about that, like, oh my gosh, if I move the money, am I going to get taxed? Not if you don't touch the money personally. If it goes from custodian to custodian, you are good. A rollover, what that means is that the money comes instead of an IRA, it comes from a previous employer plan. And that could be a 401k, 403b, 457, all these different kinds of employer plans. That's a rollover. So you open the account, you move the money into it, and then you move into phase two here, where you choose your asset. And then once you've chosen and you say, yeah, that's what I want to do, and you've reviewed the paperwork, then you submit it to us. You give us what we call the supporting documentation. And so when you're giving us the supporting documentation, it's important to remember that your personal name isn't the name of the investor. Of course, you own the IRA, but the IRA will own the asset. So it's like a kind of a waterfall there. You own the IRA, IRA owns the asset. And we review that. And then what we'll do is we will disperse the funds to the asset sponsor, multifamily here. Like I say, it's Disrupt Equity. We'll disperse the funds to them. And then you will have self-directed. Now, Disrupt Equity is going to, and any asset sponsor that you invest with is going to return the proceeds, that you have earned, that your IRA has earned back to the account. It doesn't go back to you. And if ever somebody accidentally makes a mistake, because people are humans, and sends assets, fees that are asset, I should say, proceeds back to you, and just call them, hey, there was a little mistake, because any return on an IRA owned asset has to go back to the IRA. So there they are back in your account. And like I was saying before, you can build up those returns to the point where you have enough to make another investment. So open, fund, invest, and then, hey, rinse and repeat. That's how we do it.
No, I love it. And I mean, at Disrupt Equity, again, we've had a lot of experience with the self-directed IRA investors, and we try to handhold it and educate people along the way as to what they're going to do. I mean, and each firm might be different, And I know Karen's firm is gonna try to help and make that as seamless as possible. But there is some paperwork, and there's some back and forth, and there might be a little bit of a timing lapse. So I just want everybody to realize that obviously there's a process, right? And we try to make it as white gloved and as easy and seamless as possible.
That's
Um,
true. Do you want me to talk about the timeline here?
Absolutely. Yeah, I think that's if I'm a new self-directed IRA and maybe you're interested in a future project of ours, like what am I looking at? Like how does that work?
Yeah, over the years, we've done everything we can to just make this a time gap as narrow as possible, but some things we can't go over. So opening an account used to take a lot more. Now it takes 10 minutes. So we fixed that. Being able to transfer an IRA, we've done everything we can to reduce the amount of time that it takes, but we're still waiting on a third party to move the money. So we are depending upon a third party, say your IRA custodian or the custodian of your employer plan, to move the money. But those custodians are also aware of the process, and they've over the years understood that they need to move faster too. So that can be, I think, an IRA a week at most. A previous employer plan maybe 2 weeks. That's what takes the longest in this process in phase one. But while you're waiting for phase one and the money to actually come in, that's when you're already working on phase two. You're already reviewing the docs, submitting the paperwork, choosing your asset, all of that. And we get that all queued up once you've decided and submitted all the docs. And so we're just waiting for the funds to come in. Once they hit, we can disperse the funds and boom, you've self-directed. And as soon as proceeds show up from the asset, and Ben can talk about that, about the timeliness for receiving proceeds from the asset. But once they come back, they go right back in the IRA.
Yeah. Yeah, and ultimately it depends on, the frequency of the distributions. We would do a monthly one. So each month, typically towards the end of the month for the preceding month, you would get your distribution funded into your IRA account, right? It's as easy as that, right? And I've seen a lot of people, what Kaaren was saying earlier, you that starts becoming real meaningful money, and then you look at your account balance, like, wow, I can make another investment, right? And that's the beauty of this. And yes, you can't tap into it without a lot of taxes and penalties, but this is the point of it is to help you grow more quickly your retirement account. And I think that's the one thing that people need to realize about this. And both firms try to make this as easy and quick as possible. So what investors need to know before getting started, right? So Kaaren, if you could kind of, talk through maybe the gotchas, maybe the things that people need to understand, some of the things up front.
Yeah, you say gotchas, and I've been speaking, and I go around and speak quite a bit, and twice, it's funny. People have told me that they had something called an IRA owned LLC. Now you can invest in, say, syndications and multifamily using an IRA owned LLC. It's called a checkbook IRA sometimes. But when you have one of those, you got to make sure that that you're handling it correctly. And we'll talk about some of those rules. But when I've been speaking, a couple of people have come up to me and talked about how they committed prohibited transactions. No, you don't do that. So your IRA never invests in a situation where you receive personal benefit, right? But when the IRA does invest, it is the IRA investing and not the individual. So the proceeds are paid to the IRA. The account setup, transfers, and paperwork take time. We kind of went through that timeline. It could be, say, like a week. You open your account, you could open and fund a deal. It's plausible within a week. The fastest it's been done in the whole industry is 4 days. So but you have to plan for extenuating circumstances. So I'd say, yeah, give yourself a week. If it's an employer plan, you're moving over 2 weeks. Fees, rules, and restrictions, you need to understand those up front. We can always have an offline conversation. If you'd like to email us or, go to our website, uDirect IRA, and schedule a consultation. We'll talk to you all about the rules and go really deep and, deeper than we have time to do today. But the fees for us are low. The rules, there's a rule book, and it's called the Internal Revenue Code. It's IRC 4975, where all the rules are written, but who has time to read, a book that's taller than, than the building that you live in, right? So
it's only like 9,000 pages, right?
Yeah, only just a quick little read. But they do distill these rules into publications. So if you go to irs.gov and type up publication 590590, you'll see the rules for self-directed IRAs. Basically, keep things arm's length. keep it arm's length. And there's certain people you can't invest in, and those are invest with both. And those are your ascendants and descendants in you and your spouse, a 50-50 business partner, and anybody who is a fiduciary to the plan. So those are disallowed people. You keep away from those with your IRAs. But right now, what we're talking about, unless you're Ben's, mom, for example, you're going to be okay. You just want to stay arm's length from prohibited transactions. Now, multifamily investments, like so many others, are long-term investments. And that's important because when you have a retirement account, we call that patient money, don't we? You're not looking to use those dollars to pay your mortgage. Those dollars aren't sending your kids to school. Those dollars are the dollars that are baking. It's a long bake in the oven so that you have it later in life. And when you invest in a multifamily deal, and Ben, chime in here too, because a lot of times you're investing in a deal that maybe it's ground up. And so when something is ground up, I mean, you're not cash flowing on something where they just broke ground. I mean, the building has to be built. It has to be designed, built, and then tenants need to get in there. That takes a minute, doesn't it?
And I think you hit it right on the head, which is so important, right? This is not, you're not taking distributions out of your IRA to pay your bills, right? This is meant to be a long-term vehicle to grow your retirement account, right? And so, if you're going to use this, realize it could be the best cash flowing investment. It doesn't matter if it's multi or something else. You're not going to be able to touch that. And if you do touch it, you're going to have a lot of taxes and penalties to do that, right? And so realize that, multifamily investing actually kind of coincides with that a lot. It's a long-term play. It's kind of less liquid than most investments, and ultimately there is going to be a cash flow component of it, but it's going to take time for all of that to kind of bake. And I think as long as you go into these types of investments with that mindset, your expectations are going to be, you're going to be set corrected. So, and I think the last point here, which I think is one of the things I'm trying to kind of drive home today, is do your due diligence, right? Not only on the opportunity, a lot of people get caught up in the property, right? Where's the property at? What does it look like? They get so fixated on what it is, they don't look into who's doing it. Then I think it's really, really important just to at least have a conversation, have a call, understand, who they are and who you're investing with. I think that's important, right?
And understanding, people will do this, like investors, we see a lot of times. You don't want to be the investor who's like picking up the tree to see if it's growing, like pick the tree up by the roots. Like, is it, because it is a patient kind of investment, isn't it?
Yeah.
And you definitely want to get all your questions answered up front. And Ben, I know that you guys are there to answer questions, right?
Yep. I mean, just like Kaaren and her team are on the IRA side, on the investment side, right? You're going to have a full team of people that are going to be there to answer all the questions. In fact, me and Ferris, who's my business partner here, I mean, we get on calls. That's one of our main roles, is to work with our LPs, our investors, and make sure that they understand what they're getting themselves into. And I think you need to do that on the self-directed IRA side too. Understand the vehicle, understand what it can and can't do. And then, then your expectations are aligned, right? And I think that's kind of what the spirit of this slide is supposed to be, right? So,
absolutely,
some common questions about investing through a self-directed IRA, and this is some of the stuff we can kind of go through more of these. We're kind of winding things down in terms of the presentation itself. I think the most impactful part of this is typically the Q&A. But I'll probably ask this to you, Kaaren, on a lot of this stuff. What type of account can be used?
Well, I'll just pick them off here one at a time if you like.
Yeah, let's do it.
Yeah, so like I was mentioning earlier, they say the term is self-directed IRA. That's an umbrella term, and there's a traditional IRA. That's the number one account that people use, the traditional IRA. It's pre-tax, so the money goes in, and unless you make a certain amount of money, you get a tax deduction for making that contribution. So a traditional IRA, it's got a cap right now of $7,000 if you're under 50, or $7,500 if you're under 50, and then $8,600 if you're 50 plus. So that's one kind of account. There's also a Roth IRA where the money goes in. You already pay the tax on it, but then the proceeds all grow tax-free for life. Okay. There's a SEP, which is a simplified employee pension. Great account for someone who's self-employed. There's a simple IRA, which, that's an acronym: Savings Incentive match plan for employers. The SEP really outshines the simple. So we hardly open any simple IRAs anymore. Everybody likes the SEP. And so an account that's just like the SEP in so many ways is the solo 401k. Now, the SEP is an IRA, so it is simple. The solo 401k is also for someone who's self-employed, has lots of bells and whistles, and also an HSA, a health savings account. So those are the types of accounts that could go into a deal like what Ben's talking about today. The funding process, we've kind of covered it, but you give us the supporting documentation. We're going to review it. And when we do review it, we're not trying to say, hey, this is a good deal or a bad deal. But we're taking a look, is it vested correctly? In other words, is the name of the investor correct? And do we have the right wiring instructions? We're going to review it for things like that. So the funding process, if there's money in the account, give it, maybe the maximum 3 business days typically, and we'll get it, it'll be funded, tops. The hold period, again, we kind of mentioned when you start from soup to nuts, it can be a week to 2 weeks. That's what you're looking at, depending on what you're doing. And distributions. When the asset sponsor distributes the assets, they go right back to the IRA. And so how do you know if you got a distribution, right? You just log right into your account and you can see it 24/7 in your pajamas and in your rabbit slippers, and just go on there and see if you received your distributions. It's awesome. Look on your cell phone. It's right there. Fees. Like I mentioned, we have a $50 setup fee. Flat fee of $275 per year, regardless of the number of assets, regardless of their value. And there are some other fees, like if something FedExed, or wire fees are only $15. We keep things low for you. So those are some fees that are out there. But the restrictions, again, we could have an entire event on what prohibited transactions are, because it really does go, you can get pretty granular on it if you want to. But as long as you keep things arm's length, that is a rule of thumb on the restrictions that apply.
And I think, again, folks, if you have an investment that maybe you're interested in, go back to Kaaren and her team and explain what it is, and they'll tell you if it's prohibited or not. I think that's an important, just part of the process is getting to know the people that are the custodian over your money. So I'm gonna selfishly take the first question, Kaaren. It's for
I
you.
cannot see them, so that is.
So let me see. I'm think, and I encourage anybody that's still on, drop your questions in the chat. I don't see anything just yet, but this is the time to, if you have them, raise your hand. I'll go through them. But the one question, because this pops up, and I just want to get ahead of it. You always have great responses to this anyway. Is talk about UBIT and the variations of that acronym that are out there. What is it? When could it potentially be triggered, and just a little bit more about it?
Right. I get asked this question so often because this tax can be a surprise. You invest in an IRA, you think, wait a minute, it's tax-free or tax-deferred. What are you talking about? UBIT, UDFI are kinds of taxes. So let's break that down for you. So IRAs are income tax-free, income tax-deferred. All right, it's income tax. But when an IRA invests, say, for example, even in a deal like Disrupt Equity offers, if part of their capital stack includes leverage, then that means a certain amount of a liability for UDFI, unrelated debt financed income tax, could come into play. Now, it's not a deal breaker. It doesn't have to be a lot. That's something that you do the math on when you are doing your due diligence. But it's a tax, and whether or not you pay it, you'll see it on your K-1. And so if you owe this tax, you will file a Form 990T if tax is due. It will be paid for by the retirement account. Now, you can also read about this. So if you have a pen, you want to just take a second and just jot this down. It's irs.gov, that website again. It's such a great website. But look up publication 598. And that is the rule book on UBIT and UDFI tax. Now, UBIT, unrelated business income tax, is when you're investing in an active business. And so these are kind of like twin taxes, almost like cousin taxes, I would say, but they're very similar. They're the same rate as the trust rate. And depending on what's going on here, it could range from 17% to 37%. And just so you know, that's not a tax on all your proceeds. It's just a tax on the proceeds that your IRA receives because of leverage. And that is breaking it down as simply as I can, that there could be this tax when leverage is involved. There could be this tax when you invest in an active business. So this is one of your due diligence questions.
Yeah.
You know, is that going to happen to me? So Ben, do you guys take leverage in your capital stack?
Yeah, I mean, I think most people, at least in the real estate space, are going to take some amount of leverage in there, and that's why this has been brought up because we've had to deal with this with self-directed IRA investors in the past, and so I think it also goes back to, again, this is part of your due diligence process, right? Are they taking on leverage? Is this something that I might get hit with? And these are all manageable. Don't act like that. I mean, there's still a ton of tax advantages to investing into these projects through your self-directed IRA, even with these involved, but that's where Kaaren and her team are going to shine, right? Asking them, like, explaining the deal. Is it prohibited or not? Is it going to potentially be, hit with potentially these other things, and understanding what you're getting yourself into, right? And I think that's the one big takeaway from today is doing your due diligence. So that got brought up quite a bit. In fact, recently here on a project that we did last year. So I wanted to put that out there. We got a couple questions. Luke, I'm going to get to yours here in a minute, or you want to ask a question? I'll see if I can unmute you. But first, Chris Hansen says, I'm curious if Kaaren has any insight in using an inherited IRA for real estate investing, giving the requirement for inherited IRAs to be fully distributed at 10 years.
Yeah, that's a common question. But yes, you can do this. Now, when you have an inherited IRA, yes, they have to be fully distributed. So that's again where you're doing your due diligence. Maybe what you're going to do if you want to self-direct an inherited IRA is to get into a deal as a debt partner instead of an equity partner where the investment has a fixed term. That might help you. But understand when you have an inherited IRA, it sounds like you know a lot about it already since you understand the 10-year rule, is that you're going to have to take RMD distributions, required minimum distributions. Sometimes it's based on the life expectancy of the deceased, often. So you have to make sure that there's enough cash in there that you can take the RMDs while you're also investing. But yes, an inherited IRA, we have several of them. Dozens and maybe 100 of them, where people have invested inherited IRAs, because you don't want to just leave that money idle. You want it to continue working, don't you?
Yeah. Great answer. All right, Luke, let me see if I can. I don't know if I'm going to be able to turn this on. So you would like to answer a question live. So sorry, Luke, if you could let me see if I can. Oh, here we go. Here we go. All right, Luke, can you hear me?
Can you hear me?
Sorry, man. I'm trying to fumble my way around Zoom here. So
You're all good.
live.
Awesome. I actually have a ton of questions, but I'm gonna just ask one. Do you guys bring like institutional capital, like either pref or common equity, for like LP positions or GP positions, for like real estate?
Yep. To answer your question, yes, we do. Traditionally, pref, not as much. In fact, out of the 27 deals that we've done, we've only had pref on 2 of them.
Okay.
But we have partnered with, I wouldn't call them, don't think of like institutionals like big BlackRock type people, but family offices, smaller RIAs, not IRA, RIAs, wealth management companies have been LP partners of ours. But traditionally where we've raised money is through clients of Karen's and retail LP investors. I think our typical check size across 300 million that we raised is about $110,000. So that's kind of the ticket size. But yeah, we got a few more minutes. So if you've got a couple extra questions, we're happy to kind of roll with it.
Okay. It's probably better if we schedule an introduction meeting between the two of you and my principals.
Yeah.
If you guys are open to that.
Yeah, of course.
Let's do that.
Yeah, I mean, I think,
Cool.
Mine's pretty easy. Ben at disruptequity.com, and Kaaren, do you want to?
Yeah, mine is easy too. It's info at the letter U, uDirect IRA.com. So info at, and if you can see my little, picture right there, that's our logo. So it's info at, that's the easiest way to get to all of us. And we can get that scheduled, no problem.
All right. Well, I'm
Awesome.
not seeing if there's any other questions. I do want to just kind of keep it open for me at least another couple minutes here. See some folks Tony, Fong, we got Melissa on too, Jamie. I know some of the folks, but yeah, I mean,
I
you
have
just
another
got even
question about a Reg AS.
Reg AS. All right, I'm familiar with Reg A. I don't know the S, but
Reg
what is?
AS is institutional, so you have Reg AD and then Reg AS.
Gotcha, gotcha. Okay, yeah. What about it?
Um, I'm trying to tokenize some projects and pull like liquidity out of them
Mhm.
like internationally. And I know I have to have a BFI in like the Cook Islands or Cayman Islands. Is there anything else so I don't get arrested that I would need?
I think, man, I would suggest you get with a good SEC attorney. There's a lot,
100%.
yeah, there's
Yeah.
Okay.
a lot of great folks out there. We are not attorneys, and I wouldn't want to guide you in the wrong direction. I'm not familiar with some of those mechanisms. All I would say about the tokenization is there's been a lot of people out there trying to make that happen, and I'm still waiting for a good solution. I think the one thing about tokenization that I think will make commercial real estate just the cap rates will compress and things will be like a rocket ship is it takes the illiquidity out of the investment, right? Because hopefully you can tokenize the investment and there can be some kind of a secondary market for it.
Mm.
Again, I've seen a lot of people try this. I think some people have actually been successful. I don't know how big of a market there is for that.
I think it takes the third like the it takes a percentage of the income of the rents or whatever, and it sells off like in like fractionalization, like in fractions to like investment bankers and stuff like that, right?
Interesting. Yeah, I've never seen it done like that. I was thinking like, hey, you want to cash out, there's a secondary market for your shares. Somebody can buy you out, even if it's at par or even below. It just creates liquidity. So I haven't seen it fractionalized to the revenue, place. But I mean, hey, I would say you give it another 5 years, there's gonna be a lot of creative ways to do stuff
Okay.
like
That is creative. I love that. And when you
I'm
talk
talking to
about
people in
crypto and
California who
tokens,
are doing
yeah,
that.
yeah.
yeah, they might be. There's some really smart people out there. But yeah, I mean, as far as like how to structure all that stuff, the legalities behind it, there's a lot of good SEC attorneys out there. I would suggest you get with one of them, man. Even if you got to pay for their time, as money well spent.
Yeah.
Yeah,
We'll talk.
yeah, cool. Well, I guess Kaaren. Anything else? I'm trying to see. Oh, Joe, he's got a simple question. Let me see if I can. Give me a second here. If I can. Trying to get Joe on here. Apologize, I'm not the best at Zoom here. All right, Joe, you are live, sir.
Yeah, can you hear me?
Yep.
Yeah.
Yeah, thanks for both of you guys putting this together. I know Kaaren from years ago in San Diego.
Oh,
We did this once with an investor, but it was a different custodian. But my question, it's mostly just to clarify. That guy had a great idea earlier about the crypto and the tokenizing, but just to clarify, Kaaren, your company is looking primarily for investors that either have their own retirement accounts, either held elsewhere or non-self-directed. And if they want to use those specific funds, they would bring them over to you to get set up to
mhm.
put into something like real estate, right?
Well, if someone has a self-directed IRA, this happens every day too. People will change custodians and they'll move their alternative assets to us. That happens all the time, if that's what you mean.
Yeah, more or less. If they already have a self-directed and they know how it works and maybe they invest already, they could use their current, I guess, custodian, or they could move it to your company, right? They have
That's right. Mhm.
okay. And what would be the benefit from moving it from their current one to yours, if any?
Well, a lot of times they're consolidating their assets, so they're going to put them all with one custodian instead of multiple. That's one thing. And also our fees. I mean, our fees are great. If you look at our website, you can see that. And so that's a lot of times the reason that they're paying through the nose for their account and they don't need to. A couple of the reasons.
Gotcha. Okay. So appreciate that. And then Ben, you are the so-called sponsor, or I guess is that interchangeable with the word GP, general partner? So you guys are the ones
Yep.
that actually acquire the real estate
Yep.
and raise the money. And then if those investors are using IRA funds, they would channel them through Karen's company, right?
Correct. Yep.
Okay.
Yep.
Okay.
I mean, I think that's why we promote these, because a lot of people don't realize that they have the flexibility to even create a self-directed IRA, let alone use it to invest in multifamily investments too. So I think that's why we're trying to educate investors, because there's just a lot of, I think, and I used to have an IRA with the firm that I used to be with. I think there is a lot of reason why they don't want you to know that there's other vehicles out there,
It's
right?
true.
There's, from selling their own products to the fee load that's on the money that is under management. I'm not going to call it a racket, because I'm not going to disparage anybody, but once your eyes are open to the opportunities in self-directed IRAs, I think you never really turn back, because there's no reason to.
Well, and too, Ben, like people will hear about ideas like what you have, and they'll think, wow, that's great. I really wish I could do it, not knowing that
Yeah.
they literally can. They have the power. It's like, wait a minute, are you kidding me? I can do this. And
Yeah.
as I mentioned, early on, after this many years, 50 plus years, so many people don't even know it. So even when we're talking about this today, we're reaching someone who didn't even know that this is possible. And that I think that's really cool, just
Yeah.
giving people power to do things.
Yeah, and just to give everybody that's still left on the call, I mean, we've taken 30% of our investors have come through an IRA channel.
Oh, that's awesome.
So, I mean, there's a fair amount of education that we do in this space, and rightly so, because people don't know that it even exists. So, yeah. So, Joe, to answer your question, yeah, we take in investments from self-directed IRA investors. We deploy them into these investment opportunities, and then we distribute back to their IRA accounts. And so, and both us and Karen's firm try to make it as seamless for the investor as possible. So
Yeah, appreciate that. That does answer the question. And it's mostly because my friend and I, we have, well, I'm in California, so it's out of state here, but we have some opportunities for multifamily, 8, 10, 12 unit apartments. And so typically when you're going to raise money, a lot of the capital you're raising is already in the real estate space. And
Yep.
at least from my experience, we find that most people they don't either know about or have IRA. They just have money to invest on the side because they're in real estate, kind of turning it over. And so if that's your audience, this may not be the right fit, but I'm trying to help my friend, like educate him. And so we can educate other outside investors, meaning outside of the real estate field that want to be in real estate. Hey, there's ways to get in here, because a lot of the people investing specifically in real estate, they are not the customer you may want. As far as what you guys said, you want everybody to do due diligence on your project and on the sponsors and everything. But if they're too savvy, they may try, like you said, what was it? Take your tree from the roots.
Yeah, pick the tree up by the roots to see if it's growing. Yeah.
Yeah, if it's a good investment, you should put the money in and monitor it, watch for your updates, but not try to, go and if you plant a seed, you got to water it and let it grow.
100%.
So that's kind of my take. But yeah, that question definitely answers my questions.
Yeah, I mean, there's always going to be a peaking of interest. I think a lot of people don't realize, like we're talking about tokenization, that you can fractionally own these properties, right? I mean, I remember, back in the day, I drive by a multifamily or I drive by a big office building, man, who owns that? That's got to be the Wall Street guys. Like, you can't conceptualize that you can be part of a partnership and own a fractional owner or percentage of that big piece of real estate. And how all that works. I think there's just like the IRAs, there's a lot of, not shrouding, but, miscommunication and misdirection, when it comes to this stuff. That's what we're out here trying to educate people, is that, yeah, you can buy into these smaller projects or these bigger projects, and you have fractional ownership. You don't have to have all the money to buy the whole thing all on your own. Now, you might want to, that's totally fine too. But there's another way to do real estate, and that's where.
And like what you're saying, is like mom and pop can invest just like the billionaires into the same building, right?
Yeah, we're trying to rip market share away from Wall Street and put it back in Main Street's pocket. That is our whole MO. We've been doing it for 15 years and we're going to continue to do it. And the vehicles that you do it through are Karen's firm and the self-directed IRAs. That's the most efficient way to do it if you've got retirement funds. So, well, all right, let's see if we can go ahead and wrap it up, everybody, unless there's one or two more questions. Let's see, let's check it out. Luke, I'll let you, let me see. We got about 3 more minutes, but let me see if I can promote you back on here to talk real quick again. Want to talk. There we go. All right, Luke, you're back on, buddy.
Thank you so much, Ben. Another thing that you guys probably would be easier, instead of raising deal by deal basis, you guys could build out a fund. It's easier to raise $200 or $300 million and take it to like a pension fund or an investment bank or a family office and get that done, because it's the structure's simple and it's like straightforward.
Yeah, and we've done that too. I mean, we've done funds before. It's just, I would say 80% of the investments is single asset syndications. And the reason why we do that, Luke, is it's ultimately who we're investing or who's investing with us, which is retail investors. And it goes back to my earlier statement about people like to invest in something tangible. They want to be able to drive by or look it up or know what it looks like or what area it's in, whereas the fund, depending on how that's structured, if it's more of a blind pool fund,
Yeah.
sometimes you're investing in an idea or a thesis. And I think sometimes that's for at least, less sophisticated investors, that's a little bit harder of a pill to swallow. But I agree. Let's have a conversation. I think there could be some alignment there.
Yeah, it gives you a pool of equity to pull from. So you're not struggling to, you're not everywhere trying to call investors and all your friends that that are, whatever.
Absolutely. Well, no, Kaaren,
Yeah.
thank you. I think we did another great webinar. Hopefully everybody got some value. I appreciate everybody sticking it out with us and spending their Monday afternoon hanging out with us. And we will be sending a recording out. So even if some of the folks had to drop off, or people, if you're listening to this afterwards, we appreciate you listening to the recording. But Ben Suttles, again, Disrupt Equity, Ben at disruptequity.com. Kaaren, you want to recap your contact info real quick? And we can.
Absolutely. By the way, we're on all the social media channels, so you can look us up there, but you can reach us at info@uDirectIRA.com.
Love it. Love it. Well, thanks, everybody. I appreciate everybody participating. And, we will see you on the next webinar. All right. Thanks, everybody.